So here we are on to Chapter 4, Financial Services, Savings Plans and Payment Accounts. Think depositories, think banks, credit unions, savings and loans, etc. So anyhow, identify commonly used financial services again. Compare the types of financial institutions, assess various types of savings plans, evaluate different types of payment methods. Again, this will be a short walkthrough, hopefully. Managing daily money needs, common mistakes, overspending, impulse buying, using credit. Oh, that doesn't happen all the time. It happens. Insufficient liquid assets. You don't have enough funds. It's pure and simple to cover your expenses. You have champagne taste on a beer budget. That's another old expression. I keep coming up with these, or not coming up with them, but I'll keep relating them to you as they come to mind. Using saving or borrowing, savings or borrowing to pay for current expenses. So dipping into your savings rather than just using your checking account. And all this is done online now, so this is a different world we live in. I have to laugh because I have a checkbook that's about 5 years old. I'm getting low on the checks, but I only write a few checks a year, so it'll probably last me another year or two before I have to, if I so desire, to reorder checks. Almost everything's done online now, including deposits, etc. So much banking has changed significantly, especially with COVID. At any rate, so are you using your savings, which is supposed to be set aside and not touched, or at least theoretically, borrowing to pay for current expenses, even though savings accounts don't amount to much in terms of interest anymore either. Failing to pay unneeded funds in an interest-bearing saving or investment account. So not keeping up with what? Paying yourself first. Very important to do so. So onward we go. Meeting daily money needs, sources of quick cash, liquidate savings accounts, CDs. Again, these are all financial instruments at banks and mutual funds, borrowing in terms of credit cards, personal loans. And again, both of these options, liquidating savings or borrowing, is going to reduce your net worth, because remember, net worth is your total assets divided or minus your total liabilities. So by encumbering more debt, of course, you are reducing your net worth. Types of financial services: savings, time deposits, savings and certificates of deposits. Those are the CDs. I couldn't think of the name for some reason, but CDs are certificates of deposit, meaning they're over time. They're not as liquid as checking account. Checking account is the same as cash. Savings deposits are not as liquid. You can't get your hands on, at least theoretically, you can't get your hands on the money in a savings account as quickly. Say, for example, if it's on the weekend, or you have withdrawn, you're limited the number of withdrawals you can make, for example, from your savings over the course of a month. But that's neither here nor there. Payment services, checking accounts equal demand deposits, automatic payments. So demand deposits, checking accounts are the same thing. You don't have to understand the jargon, but just knowing checking accounts are the same as cash, if you will. Automatic payments, automatic withdrawals, AWDs, borrowing for short or long-term, other financial services, insurance, investment, real estate purchases, tax assistance, trust, financial planning. It goes on and on. So asset management account, also called cash management account, offered by investment companies and others, provide complete line of financial services program, which include checking account, ATM card, credit card, online banking, line of credit for quick cash loans, access to a variety of investments. Again, specifically cash management, not, well, we've talked more about that before. Cash management means investments up to a year. Beyond that becomes capital, but we'll discuss it again going forward. Online banking, traditional and web-only bank services provided, direct deposit, paychecks, and other regular income, automatic payment transfers, recurring payments such as for utilities. You can set up payments automatically. And Mobile banking, text banking, mobile banking, or mobile web banking, banking apps, potential drawbacks, privacy, security, fees, always about fees. Online and mobile banking, again, this has increased significantly, and the marketing associated with this has changed significantly, where, of course, it's all about trying to make you pay, you, the account holder, pay for any kind of services that are rendered, and it's become much more interesting. Just a few years ago, I learned about making deposits by taking a picture of your check, a signed check, of course, taking a picture of your check and deposit it, automatically, or remotely to my checking account. And it's something, again, I just learned about that, we'll say 3 or 4 years ago. And at any rate, online access and has changed this whole banking depository atmosphere significantly. Again, the pros and cons, there's always that concern about privacy, and so always be aware of your, aware and wary of your passwords. Protect your passwords, change your passwords, all the things that kind of come along with it. Anyhow, there's benefits and concerns, and a lot of the concerns, frankly, have been, I don't want to say they're gone away, but we've kind of learned to deal with these things, if you will. It's a different world. Financial services and economic conditions, speaking of a different world. For successful financial planning, be aware of prime rate. That's there. When you hear prime rate, this is something that is kind of nebulous. It's not really. There are all kinds of different rates. There are hundreds and thousands of rates that can be charged and paid, and so on and so forth. The rate banks charge large corporations is considered the prime rate, somewhat, but consumer interest rates, rising consumer prices, that's that CPI that we had talked about before. So you just have to be aware of these things, and they've got different sources that you can kind of go to for some of this information. But the Federal Reserve is really the key for drilling down on interest rates that are the applicable interest rates, the important interest rates, if you will. Interest rates and financial decisions when interest rates are rising, using long-term loans take advantage of current low rates. Select short-term savings instruments to take advantage of higher rates when they mature. These are strategies that are involved with when the interest rate environment is changing. Rates are going up, and the inflation is on the horizon. We're seeing inflation rise in the future, and we can get into different details. But the point is that there are ways of dealing with that. Interest rates are falling. Use short-term loans to take advantage of low rates when you refinance loans. Select long-term savings instruments to lock in on the higher rates. And a lot of this is guesswork, but the main thing is to be aware if interest rates are on the rise, why they're on the rise. Interest rates are falling, why they're falling, and what the expectations are kind of going forward. It's important to understand this. This is where finance crosses into economics and it borrows a lot from economics, but we'll leave it at that. So compare the types of financial institutions, basic questions asked before choosing a financial institution. Where can I get the best return on my savings? How can I minimize my cost for financial services? Will I be able to borrow money if I need it? Good luck. The only time a bank lends money is when you don't need it, it seems, but that's an old adage, but nonetheless, it's more true than not. Anyhow, so all things to consider, all things to be aware of, or be wary of. Comparing financial institutions, determine the financial services you need before choosing a financial institution. Compare fees and convenience. Consider the safety and rates for deposits and loans at different institutions. List 5 steps to selecting list features most important to you. Rank the top 3 or 4 most important features. List local, national, and online institutions. Remember, pretty much everything is available online, regardless of the size of the institution, whether you're talking about a local bank or credit union or a national bank like a Bank of America, Wells Fargo, etc. Pretty much everything's available online anywhere. Conduct research, talk to friends, online research, personal visit if need be. Balance your needs with information collected. Financial services research, services offered, fees, disclosures, minimum balance, savings rate sheets, sample. Most banks, most depositories are pretty close in terms of the competition-wise, but it's worthwhile to walk through these things just to check the boxes off. That's what we're talking about here. Types of financial institutions. Again, these are depositories specifically. Strictly speaking, again, these are depositories. Commercial banks, savings and loan associations. Again, commercial banks organized as corporations offer a full range of services, including checking, savings, lending, and other services, including investment. So they've got investment under that same roof as well, and we'll talk about that as we go forward. But in their role as a depository, the commercial banks are the big banks, or the banks of America, etc., that are multi-billion-dollar corporations. Savings and loan associations, checking accounts, specialized savings plans, loans, financial planning and investment services. Mutual savings banks specialize in saving accounts and mortgage loans owned by their depositors, with profits going back to the depositors by paying a higher rate on savings. Credit unions are user-owned, nonprofit, specifically nonprofit, and provide comprehensive financial services, lower fees, and lower loan rates. So the members benefit from this, whether we're talking about getting some sort of dividend at the end of the year, or if we're looking at or some periodic dividend, or lower rates, as they're saying, lower fees, lower loan rates. I belong to credit unions for most of my adult life, and I've had very good luck in dealing with credit unions, regardless of the fact that they're on the smaller side for the most part. Types of financial institution, non-deposit institutions. These are also what are termed financial intermediaries. Non-deposit institutions like life insurance companies, investment companies, they are all providing financial services, if you will. And we'll get into kind of the details. It's very important point. So the other side of the financial house are the non-deposit institutions, meaning they're not involved with what's called claims transformation. They don't take ownership. So, for example, if you deposit your money into a bank, you surrender that deposit, meaning the bank has your money on the account, but the bank is in possession of that money, and it's their responsibility to, one, protect it, two, to make sure that you receive a certain percentage on that, kind of going forward. Where non-deposit institutions, the same goes for insurance companies and so on and so forth. It's the same general idea, where they take they take possession of your money, if you will, and they promise you to pay you back in some form, manner in the future. That's what the idea is. Whereas these non-deposit institutions and brokerage firms, they act as agents, if you will, for the buyers and sellers of financial products. Credit card companies specialize in short-term loans. Finance companies make short and medium-term loans to consumers at higher rates. They're at higher rates, rather. Mortgage companies provide mortgage loans. So, but specifically, the brokerage firms are they're typically banks, but they're what are referred to as investment banks. They're stockbrokers and so on and so forth. Problematic financial businesses, meaning that you have to deal with the problem, of course, is that you're not credit worthy, so you have to deal with other things. Pawn shops, where you would pawn your valuables, and you would have to pay a certain amount to get them back, a higher rate. So if you set it aside for a month, as it's saying here, 3% per month, meaning you set it aside for a month, you come back, you want to buy back your personal belongings, it's going to cost you whatever money you got for it plus another 3%. Cash checking outlets, these are early pay, and what you're going to be getting, and they're charging higher rates in order for you to do this, in order to cash your checks, to do various things. Payday loan companies, that's really the one I was referring to. Rent-to-own centers are leasing merchandise at high interest rates to low-income customers. All this has to do with, back to that credit worthiness. Car title loans, similar situation. Regular savings account, comparing savings plans, passbook savings, statement accounts, low minimum balance, easy withdrawal, insured, low rate of return, credit union equal to their share accounts. And basically the same thing. The idea again is that when you put money into savings, the difference between savings and checking, and there's not much today because there are some savings accounts where you're getting interest on those checking accounts, the demand deposits, if you will. And on top of that, savings rates, interest rates are so low because of the current economic environment, frankly. Very, very low rates of returns. Anyways, certificates of deposits, they're set aside for a certain period of time, 90 days and so on and so forth. There are various types of CDs. These are financial instruments, certificates of deposits, usually larger. They're required to hold, for you to lend that money, if you will, for a certain period of time. And again, these are all things, different types of CDs, rising rate or bump up, liquid CDs, zero coupon CDs, indexed, callable, promotional. And these are all different types of financial instruments, these certificates of deposits that have very specific treatment so far as getting interest and calling that note and getting your money back, if you will. Liquid accounts, the ones that are very, very liquid. The more liquid the account, the easier it is to get your hands on, in other words, onto that money, the lower the interest. Remember the time value of money. The longer the time that you are spent away from your money, the higher the interest rate. So if they're very short term, if they are very liquid, then they don't earn very much. Interest earning checking accounts, money market accounts and funds, so on and so forth. It's interesting to note that money market accounts are covered by the FDIC, but no, money market accounts are not, rather. Money market funds, rather, are not, MMF versus the MMA. Anyway, Series E Patriot bonds sold at half face value, $50 up to $5,000, fixed rate interest compound semi-annually, penalty if redeemed within 5 years. Continues earning interest for 30 years. Potential tax savings if used to pay tuition. There are different ways of approaching this. HH bonds no longer sold. High bonds earn fixed rate at inflation plus an inflation bump for inflation, if you will. Twice a year inflation adjustments. So these are inflation adjusted bonds, if you will. Or, again, these are all U.S. government issued, Treasury issued. U.S. savings bond, the registration, single owner, co-owners with primary owner with a beneficiary. So it's very specific. Treasury Direct is where you where you can buy these bonds through, again, the Treasury, the U.S. Treasury Department. Evaluating the various savings plans. Remember, the lower the interest rate, kind of as a rule of thumb, the more liquid the investment, the easier it is to get your hands on the money. But again, the downside is that there's less interest. They're less risky in that sense, but think about it this way. When you think about risk, think about opportunity cost. Is that if you're going to set it aside for a year anyway, does it make more sense to put it into a savings account or into and keep it in your checking account? Keep it in your checking account, you miss out on guaranteed interest, if you will. So think about that opportunity cost. The opportunity cost of keeping it in the checking account is very high. Lower the interest rates are, the lower the opportunity cost. See how this all works? It's up and down and backwards, but you just take your time and walk through slowly, and you'll you'll be able to sort through a lot of these things. At their root, they're much simpler than people want to make them out to be. So these are identifying, different things to consider when you're looking at interest rates, savings plans, etc. The rate of return, percentage increase in the value of savings, increase frequency of compounding. Remember our compounding interest, where you're getting 10% a year. You have $1,000, and so the first year you're going to keep it for more than 1 year. So the first year you're getting $100 on that 10%. So your balance after 1 year is $1,100, and then you're getting 10% interest on that $1,100 kind of going forward. So keeping that in mind, that's the rate of return. Inflation is the general increase in the overall prices, and these are all things to consider. If the inflation rate's higher, your rate of return has to be higher to offset that. Taxes also impact your decisions so far as savings are concerned. What kind of a vehicle are you going to invest in, and so forth. Liquidity, again, how long you're separated from your money, from your funds. The safety is availability of deposit insurance, for example, and the risk associated with not having that deposit insurance, the Federal Deposit Insurance Corporation, not being insured for, I think it's maybe it's $200,000 now. It's either $100,000 or $200,000 in your savings that's guaranteed by the FDIC. Restrictions and fees, minimum balance limitations for those CDs, those certificates of deposits. All the things that go along with it. For checking accounts, you have to have $500 on, in savings in order to get zero charge on your, to get, free checking, etc. All the things that go along with it, and the fees that are associated for additional transactions. If you make too many transactions a month, for example. So evaluating savings plan, the rate of return or yield. Okay, so percentage increase in value due to interest. The frequency of compounding increases return. So if your compounding is going to go on a daily basis, after 1 year, it's the growth of $10,000 with a 4% return. If it's annual, it's pretty straightforward, $10,400. Quarterly, it's a bit more. Monthly, it's a bit more. Daily, yes, things compound on a daily basis as well. So your annual yield, your actual percentage yield for daily compounding is at 4%, is actually at 4.08% on an annual basis if you annualize them. Okay, so these are all things that you have to consider. They have to be taken into consideration. Truth in Savings Act, this requires a disclosure of fees on deposit accounts, interest rates, the annual percentage yield, APY defined as total percent. Total percent is based on annual interest and the frequency of compounding. So again, if you're compounding on a daily basis, your annual percentage yield would be higher than if it, for the same interest than on an annual basis. So APY is equal to the rate per period times the number of periods per year, period. How about that? So in a typical year, we're looking at 365 or 366 days per year. So it's compounding more frequently, so it builds more quickly. Inflation, compare rate of return versus inflation rate, that's always going to be reducing so long as that interest rates or inflation is on the rise, or if there is inflation present, it's going to reduce that your savings rate or your interest rate that you're getting. Taxes also reduce interest earned on savings, the tax bill that you're associated with earning on your interest, right? Income earned from your interest. Liquidity, the availability of the cash. Again, quick availability of cash without significant loss in value. You have a home that's worth $200,000. Yes. Is it liquid? No. The reason it's not liquid is because in order for you to turn that home that's worth $200,000 into $200,000 might take 2, 3, 4 months. Anyway, you get the idea, hopefully. Liquidity is how quickly you can get your hands on that money. Savings via FDIC, NCUA. FDIC is the Federal Deposit Insurance Corporation, and the NCUA is the National Credit Union Association. It's $250,000. So it's not 200, not 100 or 200, but $250,000. So there are restrictions in fees, minimum balances, fee for additional transactions, all the things that kind of go along with that. So comparing payment plans, electronic payments, checking accounts, other payment methods, there are a variety of ways you can pay for everything, but it seems that most everything has moved into that category on the left, electronic payments. Nonetheless, there are some official payments that are out there. People have to pay, with a cashier's check, certified check, etc. And there still are traveler's checks out there. Traveler's checks are things where if people are traveling, for example, around the country or overseas, and they want to have the money available, but they don't want to have cash, they can have traveler's checks, which are typically, I think, through American Express. Maybe Wells Fargo does them as well. But you can go and if someone steals your traveler's checks, at least theoretically, they can't be cashed, okay? Or at least you're not on the hook for it. You'll be able to get your money back. So payment methods, electronic payments, debit card transactions, immediate. So debit card is straightforward. You pay right there, boom, boom, it's done. Online payments, PayPal, etc., all the things that are out there. It's moved on to smart cards, digital wallets, where you show your phone and you pay for it without any money, if you will, changing hands. It's definitely moved toward that. Credit versus debit card. Credit card is delayed payment. That's all it is. So you're buying something, but you're paying for it at a later date. Really is what it is. Versus a debit card, you're paying right there and there. It's a transaction. You've got $500 in your checking account, and you spend $50 on your debit card. Your credit card is it's debited. It's taken out. Or credited rather, debited rather. It's taken out $50 out of your credit card or out of your debit card, out of your checking account. Anyhow, it's point of sale. All these things that kind of come into play. Payment methods, checking account, regular checking account. Again, driven by minimum balances, activity accounts, fees charged for checks written, sometimes for deposits, and I've had some fees for online checking that I still haven't been able to figure out exactly what they are, but I will. Things like that. Interest earning or share draft accounts through credit unions, and there are also now accounts negotiable or withdrawal, but that's, again, some small interest that's associated with that. Okay. Evaluating checking and payment accounts, restrictions such as minimum balances, balance fees, which increase charges, interest rate, computation methods, how things are computed. Is it, are we compounded daily or compounded weekly, quarterly, monthly, quarterly again, or annually, however it's done. Special services, overdraft protection, beware of package deals that include unneeded services. So don't pay for what you don't need, really. Checking account selection factors, what are the restrictions? Is there a minimum balance involved? Make sure that you have federal deposit insurance on this, and most everything does nowadays, and is branching important, all the other things that kind of come along with this. Most importantly, I guess, would be the fees and the charges. Again, for the most part, you should be able to get away without much at all in the way of fees, so long as you're not going through overdrafts, spending, writing a check for $50 when you only have $20 in your checking account. Always be wary of this, because these are lessons learned. All of us have bounced checks or gone over, and it becomes very That's something you should not get into the habit of doing. It happens, but you shouldn't. Other payment methods: certified check, cashier's check, money order, traveler's checks. Again, these are all things that are out there that kind of ensure the transaction takes place, and it's just safer for both sides. The person who wants to issue the check, if you're writing the check, this is certified checks, cashier's checks, money orders, traveler's checks. It's safer for you, and it's also safer for the recipient, and it's easier to track, if you will. Opening a checking account, individual versus joint. 3 types of endorsement: blank endorsement, signature only, restrictive endorsements for deposit only. That's typically if you're going to deposit something, you write for deposit only. Special endorsement is pay to the order of, and that's typical check says pay to the order of. Anyhow, just these are all very, very straightforward things that we're looking at. Manage your checking accounts, writing checks, recording, and this is all done online now for the most part, so it's all out there for you. So there's no reason why you shouldn't be able to quote unquote balance your checking account, look at your transactions, see where you're at, and just being careful not to run into overdraft situations, because just because it's electronic does not mean that it's not real money. It is real money. Okay. So managing, again, your checking account, bank reconciliation, compare written checks with those reported paid. And this is a simple method. Again, you do the same thing online. You track your expenditures. You're tracking, just like we were talking about before, tracking all of your expenses, all of your expenditures, at least early on, making sure that you're not automatically paying somebody that you wanted to not pay. This happens with increased frequency, where you really have to kind of keep tabs on this. This is why it's not that you look at it every day, but you do look at it on, with more than just occasionally. Not every month, not every 2 months. Try to look at it every week or two if you can. So you're balancing the checkbook and you walk through, and this is, again, very, very straightforward. Whether or not you can down to the penny, because again, when we're looking at this down to the penny. So walking through, and just a quick walkthrough. You start with $12.50, subtract the $7.95, that gets us to $454.50. Now add the interest and rewards balance in the spreadsheet total, $450 plus the 50 plus the $4, or plus the $4 gets us to $454.50. Will's checking account balances. Okay, just walk through these things. And you can see all the transactions. Just again, because they're online, doesn't mean that you can't walk through them. You can go through these things, and you should do, again, periodically. You can download these things off of your online accounts and so on and so forth. But if nothing else, you should walk through and keep an eye on where you're at. Financial products such as savings plans, checking accounts, loans, trust services, electronic banking are used for managing daily financial activities. Daily financial activities. Keep that in mind. Number 2, looking at the commercial banks. These are depositories: commercial banks, savings and loan associations, mutual savings banks, credit unions, life insurance companies, investment companies, finance companies, mortgage companies. And then moving on to pawn shops. These are not, but this is something along the lines. They're providing financial services, check cashing outlets, and so on and so forth, right? So when you're looking at, finally, or just one more from the end here, savings plans, and evaluating the savings plan on the basis of all these things that we are interested in. The rate of return, that's the one that hits us very quickly, early. How inflation is going to impact this, tax considerations in general. How liquid is this account? How liquid is this investment? Yes, you're getting a high rate of return, but you've got to keep it in there for 2 years. You can't touch it for 2 years. You have to really consider these things. How safe is this institution that we're talking about? What are the restrictions involved? Meaning, how much can you actually pull out early without having a penalty, for example? What are those penalties? What are those fees that are involved? Lastly, again, the various debit cards, online payments, stored value cards, etc. They're increasing use for payment activities. This is just the nature of things, and it's even more so today than it was 4 or 5 years ago, and more so today than it was 1 year ago. At any rate, that's it for this chapter. Well done. And